It's a new month here at Henssler Financial, and we've found 3 important things to focus on in the market this month. Number 1, interest rates. As of the June Fed meeting, FOMC participants expected roughly 1 rate cut into year-end and 4 cuts in 2025. However, data in August saw inflation declines and weakening jobs data introduce a lower expected path for rates. The market is pricing in a year-end Fed funds rate of 4.25%, which would be 4 cuts, and now pricing in an additional 5 cuts to get to 3% by the end of 2025. This has caused bond yields to fall significantly, with the 10-year moving from 4.2% as of end of July to 3.8% currently. The yield curve has also steepened, with the 2-year yield now roughly in line with the 10-year yield. We will be watching the September 18th Fed meeting with the expectation for a cut, but more importantly, some insight into whether the market is expecting more accommodation than the Fed will deliver, with core inflation still at 2.6%. With the amount of cuts now priced in, the Fed could certainly disappoint, which could shake markets. Number 2, jobs market. The unemployment rate rose another 0.2% in the most recent July report to 4.3%. Over the past 6 months, it has risen 0.6%, which in most historical periods has been a precursor to a recession. Part-time work additions are also outpacing full-time workers, which typically indicates weakening. The BLS also just issued a significant revision to the jobs reports over the past year, indicating that growth was significantly weaker than originally estimated. This was the largest revision since 2009, and the adjustment removed over 800,000 jobs, showing year-over-year job growth falling from the prior estimated 1.8% to 1.3%. With unemployment climbing, the silver lining is labor productivity continues to improve. As of the most recent report, output per hour for all workers was up 2.7%, which remains above the long-term average of 2%. Additionally, while unemployment is rising due to workers staying unemployed longer, initial claims for unemployment have yet to see a meaningful spike. Number 3, consumer spending. Recent data has begun to point towards some consumer fatigue following the inflationary dynamics of the past few years. In the recent June report, retail sales in real terms fell 1.5%, while growing just 1.7% in nominal terms. This comes alongside warnings from McDonald's and Home Depot regarding a weakening consumer, as well as Target, Kohl's, and Best Buy reporting negative same-store sales comps year over year. However, consumers remain relatively optimistic in aggregate, and total spending as of July is growing at 2.7% in real terms. With this, we are seeing a divergence in the patterns and opinions across low and middle income consumers, which are feeling more strained, as indicated by credit card delinquencies, which now exceed 10%. Relative to higher income consumers, this makes sense considering significant gains in equity and home prices in the past few years. Also, while goods spending stagnates, services spending remains strong, especially surrounding travel and leisure. Beyond employment risk, we will be watching overall consumer spending as key to navigating towards a soft landing. And that's been your Market Minute for the month of September. Thanks for listening.